Chapter 9, which is Sources of Finance. This is for the IGCSE Business Studies. Syllabus code 0450. In this video, we're going to take a look at why businesses need finance, sources of finance, long-term and short-term funds, and how a business chooses the type of finance needed. Let's get started. Here is why do businesses need finance? First of all, a business needs finance to start up a business, and this will be known as startup capital. As we know, the definition of capital is machinery needed to produce goods and services. It is one of the four factors of production. And a new business would need capital in order to produce goods and services. Next, expanding an existing business. According to the objectives a business owner has for the business, it will plan on expanding its existing business after a period of time. And the third reason why a business needs finance is because it might be in difficulty. And there are two types of finance that it could need. The first one is capital expenditure, which is basically the money spent on fixed assets, which will last more than a year. So these fixed assets are needed at the start of a business and as it expands. So this could include things like machinery. Next, we have revenue expenditure, and it's basically the money spent on day-to-day expenses which do not involve the purchase of a long-term asset. For example, wages and rent. There are two sources of finance. We have internal and external. Internal sources of finance basically refer to the sources of funds that are obtained from the business itself. An example of an internal source of finance is retained profit. It is basically the profit that is kept back in the business after the owners have taken their share of the profits. This is also known as plowed back profit. An advantage for this is that retained profit does not have to be repaid. And you can add on to this saying that interest does not have to be paid. However, disadvantages include a new business will not have retained profit. Another disadvantage is that many new businesses will find that their retained profit is too small for the plans that they have, like expansion. Keeping more profits in the business reduces payments to owners, for example, dividends to shareholders. So this basically means that profits for the dividends will reduce. Next, selling fixed assets. This refers to existing assets which are no longer needed by the business and that can be sold, for example, redundant buildings or surplus vehicles or equipment. Advantage includes makes better use of the capital tied up in the business, and disadvantages include it may take time to sell the assets. It is not available to new businesses since they have no surplus assets. Next, selling stocks. This is basically known as the running down on stocks for cash, and this reduces the opportunity cost and storage of high stock levels. So if you do sell your stock, you will not have to pay that much money for cost. The disadvantage includes it must be done carefully to avoid disappointing customers if not enough goods are kept in stock. For example, after you have sold your stock, a customer may want to buy it off of you, and if you do not have it, then they may be disappointed. Next, owner savings. So a sole trader or members of a partnership may put up more of their savings into an unincorporated business, and since these owners are not separate from their businesses, this type of finance is internal. So we do know that in unincorporated businesses, the owners are responsible for all the debt. Hence, this will increase the risk taken by the owners. And a disadvantage also include savings may be too low. However, there are advantages, which include it should be available to the firm quickly and no interest is paid. Next, external sources. These are sources of funds that are obtained from individuals or institutions outside of these businesses. First one we have over here is issue of shares. It's basically selling these shares to the public, but is only possible for limited companies. These include private and public limited companies. Advantages include permanent source of capital, which does not need to be repaid to the shareholders, and no interest is paid. However, disadvantages include dividends are paid to the shareholders, and dilution of control due to the new owners. As if a new owner has more than 50% of the shares, that means that they are in charge or in control of the business now. Next, bank loans. It's money borrowed from the bank that is returned with interest. You can already get a disadvantage from here, and it's basically that interest has to be paid and the money borrowed has to be repaid. Since we are on disadvantages, another disadvantage is that security or collateral is often required. So it's basically a guarantee to the bank that will ensure the bank will get the money that the business will pay back. So this is often like buildings or houses. Advantages include it's usually quick to arrange, can be for a varying length of time, so you do not have to pay it back all at one go. So technically it does offer a little bit of flexibility. Now, large companies do benefit from financial economies of scale. If you are not comfortable with economies of scale, you need to revise Unit 4. Alright, next we have debentures, and it's basically long-term loan certificates that are issued by limited companies. Debentures can be used to raise very long-term finance, for example, 25 years. However, as with loans, these must be repaid and interest must be paid. Next, factoring of debts. Debt factors are specialist agencies that buy the debts of the firms for immediate cash. So they may offer 90% of the value of an existing debt and collect it from the debtor for the full amount, hence 100%, making it a profit. The advantages include immediate cash is made available, and the risk of collecting the debts will no longer be ours, or the businesses, but will be the factors. However, disadvantage includes the firm does not receive 100% of the value of its debt. Instead, it receives 90% or even less. Next, grants and subsidies from outside agencies. So, outside agencies like the government or not-for-profit institutions can support businesses by giving funds in the form of grants or subsidies. Advantage includes they do not have to be repaid. However, they are often given with conditions that the business has to comply with in order to gain the money. For example, location choices, employment preferences, and etc. Next, microfinancing. In many low-income developing countries, traditional commercial banks have been very unwilling to lend poor people because the size of the loan, which is small, means that the business will not make a profit and that the poorer groups in society cannot afford a collateral. The institutions that lend the poorer people money can include postal savings bank, finance corporations, credit unions, and development banks. Advantage includes specialist institutions have been set up in most developing countries to meet the financial needs of poor people, especially poor entrepreneurs. This lowers unemployment and helps in raising the standards of living of the people. However, the profit generated is very low to the microfinancers because the size of the investment is very low, and there is a risk on non-payment by the borrower since the chances of failure are much higher than the most. Here's a summary for the sources of internal and external sources of finance. You can take a screenshot and refer to this later for revision purposes. Alright, next we're going to look at splitting firms in terms of longevity. So we split firms in terms of short-term and long-term finance. So short-term firms basically provide the working capital needed by the businesses for day-to-day operations, and it is the finance needed for 1 to 3 years. The first example we have is overdraft, and it's arranged by the bank. So it basically means that the bank gives the business a right to overdraw its bank account or basically spend more than what it is currently in. Now, the firm can use its finance to pay expenses but cannot do this indefinitely. It is flexible but only to a certain extent because you can overdraft every month a different amount. Interest will be paid only on the overdrawn amount, and it's cheaper than most bonds. However, disadvantages include interest rates are variable, unlike most loans which have fixed rates. The bank can ask for the overdraft to be paid at very short notice. Next, we have trade credit. So this is when a business delays paying off its suppliers, which leaves the business in a better cash position. Advantages include it is almost an interest-free loan to the business for the length of the time that payment is delayed for. Notice how I said almost, because the supplier may refuse to give discounts or even refuse to supply any more goods if payment is not made quickly. Next, factoring of debts. You can refer to the other slide that I explained this in. Okay, now let's move on to long-term funds. So finance that is available for over 3 years, and this purchases long-term fixed assets, update or expand the business, or finance a takeover of another firm. First example we have here is bank loans. It's obviously money just borrowed from the bank that is returned with interest. Again, you can take a look at the previous slide or just read this by yourself. Next, hire purchase. This allows a business to buy a fixed asset over a long period of time, which monthly payments will include an interest charge. So, an advantage includes the firm does not have to find a large cash sum to purchase the asset. However, disadvantages include a cash deposit is paid at the start of the period, and interest payments can be quite high. Next, we have leasing. So, leasing an asset allows the firm to use an asset, but it does not have to purchase it. So, monthly leasing payments are made, and the business could decide to purchase the asset at the end of the leasing period. Now, some businesses decide to sell off some fixed assets for cash and then lease them from the leasing company back, and it is called sale and lease back. Advantages include the firm does not have to find a large cash sum to purchase the asset to start with, and the care and the maintenance of the asset is carried out by the leasing company. However, the total cost of the leasing charges will be higher than the purchasing an asset. Next, issue of shares. I did cover this before. However, in this certain case, there are two more disadvantages. Let's take a quick look. Dividends are paid after tax, whereas interest on loans is paid before tax is deducted. And the balance of ownership can be affected by a large share issue. Basically, what the second point is, but how you can explain it even further. Next, debentures. Again, you can take a look at this from the previous slides or just read it by yourself. Here's a summary you can screenshot. Finally, how do businesses choose the type of finance needed? So there are five key things that they need to look at before they choose the type of finance needed. The purpose and time period, amount needed, status and size, control, risk, and guarantee. That is it for today's video. Please make sure to subscribe and like this video. See you in the next one.